Hi, everyone. John Boardman here, joined by Andy Reynolds. We did this a few years ago, and I think it was very popular among clients. Just sort of a year-end video. We do have a few weeks left in the year, so surely enough, things are going to happen between now and December 31st. But what we're going to do today is actually present to you 7 different topics that we think are important and really common conversations that we're having internally and also having with our clients and prospects. So what we wanted to start with initially between the two of us was just talking about the markets and really since COVID. I mean, we are coming up in, March on the 5-year anniversary of COVID. It's hard to believe it's been 5 years now, and sort of talk about, and we'll show some of these charts during the presentation that we have in front of us, but how have the markets behaved since COVID? I mean, if you had to put your kind of a quick summary on how it's performed.
So I think words-wise, I'd say remarkably well. If we look back to, I think everybody's kind of reset point is back before COVID, and those 2 years of COVID. I don't know if y'all are like me, but I can't fathom that idea, and those 2 years kind of disappeared in my memory. But it's really the reset point, and when we go back to usually pullbacks in the market, that's where we kind of look back to. So remarkably well. Interest rates have obviously played an effect. Inflation has played an effect. But if you look at almost every asset class, things have done pretty well. Obviously, there are the big names that we all have seen, and before COVID, they were doing well, and since COVID, they have done a lot better. Mm-hmm. NVIDIA being the biggest one that has gone to the moon, and we'll see what happens there. But the Magnificent Seven have done really well, with most of them up over 100%, NVIDIA up 2,140% since the beginning of 2020, which, again, remarkably well, I think, for that subset of names.
Yeah, I mean, for a company that really built itself on building, video cards, for your PC, they just happen to have the right architecture of technology that's benefiting from this AI wave that's coming, which will be one of our topics we're going to delve into just a little bit more. Looking at this chart, I think we have really 2 significant periods. We have the recovery from COVID, and so we all know so much money was put into the system essentially to keep the economy standing up, and with that, we saw a couple huge developments, one of which was inflation. And so when inflation came in so high, really peaked at 9.1%, and obviously the Fed felt a little behind the curve on that one, and so they had to increase rates pretty quickly. And so that's when we started to see a bit of a sell-off in 2022, particularly on the technology side, but that was short-lived, and you saw really in 2023 and all the way through now in 2024 a recovery since. Inflation appears to be somewhat under control, but we now know that President Trump will be in office next year, and with a number of policies being proposed, which we will delve into in one of our next chapters, a lot of discussion about tariffs and how that might impact inflation moving forward, and really the interest rate environment that I think will respond to inflation, as it has. So it's been it's been a pleasant surprise, but as we've discussed in the past, inflation may be actually helping parts of the market. There are downsides to inflation because it hurts the budgets of normal people just walking around, going to the grocery. Everything's more expensive, but companies that price their goods and services do get the benefit of an inflationary wave. So I think that's one of the things we're seeing in the market.
And I think that's so important to think about the inflation. And you mentioned 2022 and 2023. So if we look at the chart, those years remarkably zeroed each other out effectively in many asset classes, if not all asset classes. So 2022 value is up, 2023 value kind of is down. 2023 zeroed back out. Same with large cap growth. But if you look at these numbers and move out of that period of time, if we look at that relative to inflation, the numbers have been good. Small's up 10-ish, mid's up around 11, similar. Large cap growth obviously has done the best. Large cap value has trailed. But then international is up mid-single digits. But when we look back at that, inflation's so important because we got to look at the after inflation return. Those numbers come back down a little bit, and it's still remarkably well. It's still a good period of time. If you ignore the Magnificent Seven, I think most people would be really happy with where their portfolio sits. Sometimes you can kind of pin to those handful of names and say, gosh, I wish I had it all in NVIDIA, and I'm sure everybody does. We may have been fired by everybody if we did that. But the after inflation return is really important, and probably more important in the bond market as well. So equities are only a portion of where we invest. Bonds are another portion. And if you look at the bond market, values came down a little bit as interest rates rose. We've kind of stayed the course similar on where we've been in the dollar amount, the value of the bond mutual funds and whatnot, bond positions when you mark them to market. But if you look at the yield, that's, I think, one of the most interesting spots. Everybody feels great getting a 4.5%, 5% return in their money market or on their treasury. But when you step back and you look at that relative to inflation, over this time period, inflation is up 22%. It's about a 4.5% annualized inflation run. Well, all of a sudden that 4% yield, 4.5% yield, doesn't feel as good when you look at it relative to inflation, your after inflation return. Depending on different periods of time, before, it's interesting to think, gosh, my 1.5%, my 2% return on my money market, on my treasury, on my CD, that may have actually been better.
Oh yeah,
inflation
real
adjusted.
return for sure.
Right.
Yeah, I think the one, just looking ahead at the next year, I think the big theme is just going to be market breadth. I mean, you mentioned the Magnificent Seven. Post-election, most of those names have done pretty well. Some of that due to potential regulatory, burden that might not be there moving forward. But I think we've seen some market breadth this year where those other 493 names of the S&P 500 are participating.
Right.
That will be the big story. And I know you and Brian are going to dig into some valuation metrics, just sort of looking historically, because I think that's, in any environment, and this type of environment particularly, I think it's just important to take a long-term perspective and look back to say, are there potential bubbly activities that are happening in certain areas of the market.
Yeah. And I think just one thing to kind of conclude as we look over the past several years, it's really important to remember how you're investing. So the person who had zero equity exposure over this period of time, the amount of money they can, the amount of purchasing power they have with the money they have now is significantly different than those who had equities. So it's always, we're going to talk about rates later, we're going to talk about debt, we're going to talk about looking forward, but it's always important to just remember inflation's a big factor in the long-term picture. And as we're looking at some of these returns over the past 5 years, inflation's definitely helped. It's definitely contributed to that. And that's why being an equity investor is there's, for almost everybody, if not everybody, almost everybody, there is some part of your portfolio you got to have exposure to these, because these returns help you get an after inflation return.
That's
so
exactly
I think that's
right.
important.
Yeah. So we hope you enjoy each of these different chapters that we're going to talk about today. Like we said, it's a good overview of the ongoing conversations we're having and continue to have, and we'll have through the the next several months as things play out. But we hope you enjoy.
Looking back from COVID obviously is a natural way to think about the markets, and obviously the world's changed and the markets have reacted as such, and technology has been a big impact to that. But we also think it's important to take a step back and look historically, and we can glean a lot of information from where we've been and help us maybe identify where we're going. So I'm here now with Brian Burtz, our Chief Investment Officer here at Ballast. So Brian, as you're thinking about the market's historical perspective, give us your thoughts.
Sure. Yeah. Thanks, Andy. We use a lot of different tools to look at valuations, and one of the ones that we really like to look at is called the Buffett indicator. It takes a look at the total U.S. stock market versus total U.S. GDP. So this chart shows you that total U.S. stock market right now is about $60 trillion, and total U.S. GDP is around 29. So the Buffett indicator tells us that we're about 2 standard deviations above the trend line. So meaning that U.S. stocks do look pretty expensive based on historical valuations. That being said, another thing to consider, this is just one tool that we use, right? Among many. Doesn't mean it's necessarily time to get bearish on U.S. stocks. just one thing to keep in mind. Valuations typically are not a great indicator of future performance.
Right.
And that sounds counterintuitive, but it is factual in the short term and immediate term. So,
And obviously those, not to interrupt, but obviously the standard deviations are significant, right? So, looking at the chart, we've seen it happen a couple times in the past, and some of them have led to significant downturns. But that doesn't necessarily mean that data point is leading to a downturn.
that's right. To your point. Yeah. Stocks can remain at rich valuations for an extended period of time without some kind of fear catalyst. This trade could continue for some time.
That's right.
But if you look, at this next chart, you were talking about PE ratios of mega cap stocks versus large, mid, and small. And this shows you that, we're always looking for different areas of the market where we can add value to client portfolios. And right now, looking at this chart, mid and small cap stocks look historically cheap in comparison to large cap, and particularly into mega caps.
Yeah.
So those top 8 companies that have taken on such a large percentage of the overall index, they look pretty expensive. And, small caps have not kept up in the last, decade or so, but it wasn't that long ago, from 2000 to 2013, where small caps dominated the S&P 500. They were up 177% over that period versus 64% for the S&P.
Right.
So important to keep our allocations there. We don't know when that trend's going to flip.
Yeah, and I think if you look at, really, if you want to nerd out, there's a really cool YouTube video where you can look at the market cap leaders by the year, and it goes, back 100 years or so, and it shows these companies that, rise and fall.
Yeah.
And, the names, we were talking about this earlier with John, the names, that have done really well, they have done well. And technology has been a big part of that. And some of these names like Amazon, what is it Amazon anymore, right? It's hard to tell. Facebook, Meta, what is that? And it's obviously evolving. But I think what's important is the valuations do matter and the PE ratios do matter. Ultimately, it is the fundamentals of investing, right?
Sure.
And so we want to understand these things, but it doesn't also mean that we have to have a sell-off for the valuations to come back in favor. So just because a valuation is, what we would call, high or whatnot, it doesn't mean that we necessarily need to go away from that.
Right.
It can easily be also that there are just other areas that look really healthy and really attractive that we want to have money to. And, I do question where some of these valuations are gaining so much momentum. Obviously, they're attractive companies. And I think most people, if you were to say, hey, here's $100, put it on a company that 5 years from now you think is going to be higher, pretty safe bet is some of those big names. Not that we're predicting that that's going to happen, but it makes sense. You use them, I use them, they're all around us. But I think there's been momentum behind that. I think, they're the forefront of evolution, but also the way that we're investing has changed. Sure, where there's more passive investing, and the more people, the more groups, institutional investors that are moving more into passive index investing just by the nature of how it works with the market caps. There's more money going into that. We have charts showing, passive investing versus active investing. The challenge with that, though, is concentration rates, and it's something you've talked about in commentaries in the past. And we are at a more historical concentration of the smaller number of stocks than we've been in quite some time. And I don't laugh, but it's interesting. If you look at the Russell 1000 growth and you think you're diversified, 1,000 different stocks. Well, top 5 of them represent 40%. 40% of your ownership is 5 companies, right? And it's been a great time to be an investor in those 5 companies, but it's really important to understand how that's going to work. And your comment on small cap, we can't have everything just in that one asset class, because things will at some point revert back to norms and valuations will matter. We got to have the things that look attractive in the portfolio as well.
That's right. Yeah. So to your point, even in the S&P 500, one of the largest index funds for that index is SPY, the spider, and it's 26% top 5 companies.
Yeah.
Point. Apple, Nvidia, Microsoft, Amazon, and Meta represent over a quarter of that. That's 500 companies, and 5 of them represent over a quarter of the index.
And the hard part is where we have clients who come in and they own those companies. They're like, and part of our recommendation for a lot of people is we need to diversify out of that. We need to sell them. And people are like, well, hold on, you don't like Apple, or you don't like Amazon, you don't like Google. It's not that we don't like them, but there's becoming inherent risk, and especially if you've owned them for a while, you have, talk about systematic risk and non-systematic risk. You have new risk by having such a concentration in one position.
Yeah, and that's why we like to own, other large cap than just market cap weighted indexes. Right? We own equal weight, different, factors in large cap space, right? Because we don't want to be that concentrated in those 5 million and try to smooth out volatility when those top 5 eventually do come back down to earth, because that is likely to happen at some point.
That's right. And I think it's important also, you shared a chart a lot that I'll let you talk about. But if you look at valuations are inherently how we buy and sell position stocks. So valuations can move, they can look attractive, they can not look attractive, and that can last a while. But ultimately, valuations do matter, and they're going to have to matter. Otherwise, or just hoping, we have to have some fundamental thoughts. And, as you look at PEs between U.S. stocks, non-U.S. stocks, they're both a little bit higher. U.S. is a little bit more higher than non-U.S. And we've owned non-U.S. for a while, and obviously should have put it all in NVIDIA, as I joked earlier. Everybody would have fired us, but it would have worked really well. We would have done well. So talk a little bit about the non-U.S. piece of the puzzle and why we own that, and historically where that's been and what that looks like over time.
Yeah, so if you look at the outperformance of chart of U.S. versus developed international, a typical outperformance cycle in this space is about 8 years. Right now, the U.S. has outperformed for 13 and a half years. Right, so definitely an extended period of time versus historical averages. But it is super important to own companies outside of the U.S. in our investment portfolios, and we will continue to do that. We don't know when this trend will flip. I wish I could tell you, it's going to happen on such and such date, but we don't know that. But it is so important to maintain the exposure in those areas. We're trying to limit, volatility. We're trying to smooth out returns, lower risk on our client portfolios, and owning assets outside of the United States provides that over the long run in an investment portfolio. So we will continue to do so.
I think, we'll talk a little bit about the U.S. debt, but a lot of that I think has to somewhat go back to the financial crisis, go back to COVID and what our government did in reaction to that. And, there's a lot of money that came into our country, and I think that has helped led to some of our markets doing better. Part of that is just a bigger money supply. And so if you look at, I think probably the U.S. has navigated both of those better than others. But, there may be a time where the U.S. economy is less in favor in investors' eyes than perhaps others.
No doubt. we've definitely seen, probably heard the term U.S. exceptionalism over the last decade and a half. The U.S. has been beachfront property for return on capital, no question about it. And, I don't want to say it's likely that continues, but there's a good chance that continues, at least in the short run. The tailwinds of the administration from the economy, right? It's been the best place to invest for quite a while. And without some kind of something breaking, and be able to tell you to be that way for some time.
Yeah. Talk a little bit about bonds. The equity markets are the fun side. It's the sexy side. It's what leads to news cycles. It's the side that, goes up a lot, goes down a lot. So, everybody rarely get questions about the bond market.
Sure.
Get a lot of questions about the stock market. Talk a little bit about bonds historically.
Yeah. So, I mean, we've been up until, probably 3 years ago, we've been a 40-year, bull market for fixed income. So rates since 1980 have come down from, somewhere around 15% on the 10-year, got down to as low as 1, I believe. So owners of fixed income benefited from appreciation in just owning bonds, not just the interest payment that they were receiving for holding the bonds, but also those bonds were appreciating in value over those 40 years, which is a crazy long stretch for that to happen. If you look at the chart now, rates have gone back up. The Fed has raised rates a few times with the inflation spike in 22. So bonds, pretty much not earning anything, right, for a while. And now, the 10-year is paying you, I think, 4.35.
Yeah.
At this point, with inflation somewhere in the mid twos, you're getting a net real return on those of around 2%, which we hadn't seen in quite a while. So bonds are not exciting, no doubt. They're not that fun, but they do typically protect principal in sell-offs and stock market. And that's why we own bonds. We own bonds not for the appreciation. Hopefully there is some along the way, but we own bonds for interest and for protection of principal.
Yeah, we're probably not going to get the appreciation that we can get the appreciation that we got over the past however many years. It's funny, last time we did a structure of this type of video, I think in the bond section, I forget exactly what we said, but basically we said we don't like it either. But we got to have them, to your point, of capital protection, getting coupons, getting yields, all that is low. I will say you're spot on with the differential between inflation and rates today. If you look back since COVID, as we mentioned earlier, the average inflation around that time period was about 4.5%. At the same time, the average yield of bonds was about 4.5%. So real good value that we got out of bonds. We haven't seen a ton of it recently. So if we can get that spread, if we can keep the spread we have today, that would be really good and really attractive. I had a question the other day, like, what's the long-term average of bonds? I'm like, there isn't one. Like, if you look at this chart, it went sideways up and went straight up and went straight down and went sideways down. And, a lot of that has to do with inflation, what the Fed was trying to do to combat inflation, coming out of that environment. But it's hard to explain, like, the historical long-term average of bonds, because it's really been two different shifting dynamics. And where we go from here, I think, is it's a great question. Hopefully we have stability.
Yeah.
If we can just get a nice little yield and move on from that, I think that's important. The old adage of take your age, 100 minus your age, and that's how much you should have in bonds. That worked really well when rates were coming down.
Yeah.
Now it's a new thought process. So, a couple takeaways. Anything you want to add? Otherwise, we haven't talked about.
No, I think that covers it. I mean, there's so much more that we could talk about when it comes to fixed income and what the outlook looks like based on what policies are going to come into play in the next year or so. But to keep it brief, I think pushed it almost to talk.
Yeah, definitely. And so, I think key takeaways: know what you own. The markets probably look expensive right now, but that doesn't mean anything. We can be expensive for a long period of time. It doesn't just mean because of it's expensive, the market's going to sell off. Market could sell off. We try not to predict what's going to happen over the next 6 months. We try to own asset classes that multiple different asset classes can do well in different scenarios. And then most importantly, just have a plan and allocate your equity portion of your portfolio correctly the way it should be. And then we continue to navigate through things. And we'll talk about several of the other things here shortly in the following videos.
Frank and I are here talking about interest rates and the Fed. Frank, I love this topic. It is like the General Hospital or the Bold and the Beautiful of financial planning, because I learned about the Fed and gave my first talk to our clients 10 years ago, and I'm still here watching and relaying this drama. What's going on with the Fed? what are they doing with interest rates? How does that affect the economy? How does that affect investors? So let's just get into it with one term that I know our clients are always hearing when they read financial media, and that's the yield curve. What's important about the yield curve to investors?
Yeah, so the yield curve is kind of a representation of what the yields are doing. And the yield curve is one of the most important, one of the most accurate historic predictors of when a recession is coming. Specifically, when we're looking at the 10-year versus the 2-year yields, anytime that inverts, so you take the 10-year yield minus the 2-year yield, anytime that goes negative, which we can see here, anytime we go below that black horizontal line on this chart, you'll see soon to follow is a recession, and that's the vertical gray lines there on that chart. But it has been historically, anytime that the yield curve has inverted, a recession has shortly followed thereafter.
It's a great predictor of a recession, yeah.
Yeah. So Cam, what is the yield curve? Let's talk a little bit more about that.
Yeah. So you just described it. The best measure, or the kind of the rule of thumb people use is 10 minus 2, but the yield curve is just what government debt pays for any given maturity period. So chart number 2 here, this is what I call a normal yield curve, looking back to 2021 before all this rate action happened, sloping from lower left to upper right. The longer you promise out debt, the higher rate of return you should expect. That's a normal yield curve. Yep. So if we look at chart number 3, this is an inverted yield curve. This is the last few months where we have the short term on the left paying out higher rates than the medium term and long term as you go along the right side of the chart. So that's what an inverted yield curve looks like, is short term rates are higher than long term rates.
Yeah.
So then if we look at the action on that chart that you showed us first, zoomed in basically since COVID here, we've been inverted since the summer of 2022, just until about a month ago. So the longest yield curve inversion in history we've been living through for a couple years. So you said yield curve inversion is a big predictor of recession. And we've just lived through an inversion that was the longest in history. So does that mean we're headed for a recession?
Well,
or is now maybe something different?
I mean, the short answer there is yes, we're heading for a recession. And I say that only to say that anytime we're not currently in a recession, yeah, we're heading for a recession. But I think to your point, Cam, there's something a little bit different. If you look back at historically what just happened here, we had the COVID pandemic. We shut down the global economy. We shut down our U.S. economy. We had a ton of federal spending, a lot of stimulus injected into the economy. Inflation went through the roof.
Yep.
And now if we're looking at this chart here, if you go back a little ways further, you can see that rates were effectively zero. To combat that inflation from the stimulus, the Fed had to do a quick series of rate increases. So what does that do? Artificially, it's going to kind of increase the rates, the yields on the shorter end of the curve that may not necessarily be tied to normal day-to-day economic activity,
right,
but kind of artificially bumping up that short-term side, which could lead a little bit to that yield curve inversion. So, to the question, are we heading for a recession? I mean, the easy answer is to say anytime we're not in one, there's one on the horizon. But is this yield curve inversion different? I think you could easily make the argument that it is a little bit different there.
Right, yeah.
So with that all in mind, Cam, where do you think we go from here?
Yeah, that's the question of the hour, right? So a few ways we can think about the path for rates is, let's go to the horse's mouth. Let's look at the dot plot. That's the chart of where the Fed governors think rates are going over the next year. If we look out December 2025, this time next year, the Fed median thinks rates are going to be at 3.25. So that's 5 cuts from here. So now let's go look at the betting markets where people buy futures and put their own money on this. They think the median is going to be 3.75. So that's 3 rate cuts. So we have the Fed sitting here saying, yeah, we're going to be down 1.25%. The market says maybe more like 0.75%. Yeah. If we look back this year, we were expecting 6 rate cuts. Beginning of the year. That's what the Fed said. We're at 3. We might get a 4th here in December. So the Fed has kind of lost its street cred a little bit over the past couple of years, being maybe overly rosy with how quickly we cut. And the market, if we look at chart number 8 here, has really started to take that into account. So I have 3 different months here, August, September, and October. That first move, number A there, That's the 50 basis point rate cut in September. So from August to September, you see the short end of the curve comes down because it believes the Fed here.
Yep.
But now, no Fed action over the next month. If we look at the difference between September and October, that's that red line going up to that green line. That's what I'm calling B there. The Fed did nothing over that time period.
Yeah.
But the market is sitting here saying, we don't believe midterm rates, that part of the curve is probably the, 3 to 10 year part of the curve. We don't believe rates are going to stay low that long. So
Yeah.
we have this narrative of higher for longer.
Yeah.
Why is that? That could be the inflation we were talking about.
Yeah.
The threat of inflation rearing its head or not getting tamped down all the way begets the idea that inflation can happen, and it lessens our expectation that rates can come down. So is that Trump trade, or is that the market prior to the election thinking no matter who's in office, they act like they're going to be spending money like it's going out of style?
Yeah.
I think that's kind of irrelevant at this point, but stimulative spending is what's been in the water
Yeah.
before and after the election. So the question is can we combat inflation, and can we continue and kind of wrap up this soft landing? That's what we're going to be thinking about when we're watching the Fed and seeing how that flows through the markets.
Yeah. We're keeping a close eye on it going forward.
Yeah.
Hi, I'm Brian Burton here with Cameron Hamilton, and we're going to talk about a hot topic, which is tax reform. So during the campaign trail, we heard a lot about tax policy, and now that we're post-election, we know that the Republicans have control over the Senate and the House of Representatives. We know that tax policy is going to be at the forefront of what they're trying to get done from early on. In particular, the extension of the individual income tax cuts, along with the estate tax provisions of the 2017 Tax Cuts and Jobs Act. Almost all of which are set to sunset at the end of next year. So we've also heard quite a bit about some potential changes on the corporate tax front. So
Right.
I'm here with Cameron, our
Yeah.
in-house expert on the U.S. tax system. So Cameron, if you could kind of walk us through kind of what you see coming down the path as far as tax reform and
Yeah.
kind of how you see it playing out over the next couple of years.
Sure. And maybe it helps to start with a little bit of recent history. So you talked about the 2017 bill, Tax Cuts and Jobs Act. A lot of people call that Trump tax reform. So we enacted tax cuts, but now you say they're sunsetting at the end of 25. So January 2026, if nothing happens, these sunsets revert back to the old law.
Right.
And why is that? Because they created so much deficit that it didn't test out with the Congressional Budget Office to be sustainable.
Right.
So they have to put in tax cuts, but I think the idea is if the same regime is there, probably they get extended. That's what happened with the Bush tax cuts, time and time again. Actually, both parties extending those.
Yeah.
But if nothing changes, we go back to the old regime. So imagine, we're back here now in 2017. Standard deduction is half of what it was, and there was no cap on state and local tax. So those are both things that got introduced. So your high income earners, if we're paying $50,000 of state tax, since that change in 2017, that's limited to $10K, and that's a huge limitation
Right.
that got rid of a lot of itemizers, and then also doubling the standard deduction got rid of a lot of itemizers. So our clients, probably if 30% of U.S. tax filers itemized back then, probably it was 70% of our clients. But if you look at all of our retired clients, okay, I don't have a mortgage, I don't have big income, it's basically medical, charitable deductions, so they're not itemizing. So that's a change that if it doesn't get acted upon, we'll be back to the old regime. I expect that to get addressed somehow. The state and local tax limitation is very unpopular politically,
Right.
but the question is, where do you go to pay for
That's
it?
right.
Yeah. On the business side, you had QBI, so Section 198(9A), qualified business income deduction. That's an awesome 20% deduction on pass-through businesses. A few businesses, like service businesses,
Like us.
have a limitation on income, but business owners have really been enjoying that. That lapses if there's no action. I expect that probably gets kicked up. Bonus depreciation. Remember the days of I can go buy a big truck or a piece of equipment and depreciate it all in 1 year. It's slowly been cutting down. What is it next year?
Yeah, I think we're at 40%.
40%, yeah. So that's scheduled to keep decreasing. That may be a wait and see for businesses, because maybe the idea is that gets reintroduced. Likely path from here. I was afraid a couple months ago, if we had split Congress, that this could become the fiscal cliff all over again, because we have to say, are we extending or not? And there's going to be a lot more push and pull. Now where we're red, president in both sides of Congress, it's likely this gets pushed through on reconciliation early on in the year.
Right.
So that means bird rule will be in effect, so we'll have to get tested out. And I'd say probably neutral to beneficial for households and businesses. But the real question is, if you try to introduce more pro-business corporate tax cuts, reintroduce tax cuts on research and development, bonus depreciation, like I say, it's got to come from somewhere. And so maybe you can be less helpful to the households.
Yeah. So I mean, when we think about these changes and how it'll affect investment portfolios for our clients, we really have to take a step back, and look at, say, it's really perception versus reality, right? Trump V2 is certainly a different economic landscape than what he faced in 2016, right? We were running huge budget deficits. We have the national debt at $36 trillion. Those type of things are going to probably potentially put a ceiling on what all can get passed through. So that's something we're thinking about, not to mention the economic landscape itself is different, right? Interest rates are higher. The national debt's higher. With immigration changes, we may potentially see pressure on the labor supply, right? So all these things are going to make things a little bit more challenging, I think, for this administration to just pass through everything that they want on tax policy.
Yeah, and we did our one-time juice the first time cutting corporate tax rates.
Right.
So how low can we go?
That's right.
Because we have a lot of private companies doing tax inversions, and if you go look at Ireland, something I read last week, we're the huge beneficiary of all this tax income. Now we know about companies going to Switzerland. So we're not operating in a vacuum here.
That's right.
Yeah.
That's right. So you want to give us some quick takeaways from our conversation here?
Yeah, I'd say just big picture on tax reform. When we thought about what we're going to say at the end of the year a month ago, we thought this might be like a pull your hair out situation that is really front page all year. I'd say it's probably going to be less news for our clients. As far as planning and takeaways that we need to consider, if you are one of these people who has been non-itemizing but then itemizing some years, so maybe we're helping you bunch gifts, use donor advised funds, we need to think about if that's still going to be the strategy for you, and that depends on how reform gets carried out this year. Estate tax, we didn't talk about it much, but it's going to get cut in half in the sunset. I expect Republicans to extend that larger estate tax to your $10, $15 million households that would be maybe scrambling to give money into trusts out of their estate. Probably not as big an emergency when you talk to estate attorneys now. And then one little nugget for our clients. If you're selling a house and you're going to potentially pay cap gains, we got a big house or an older house, or maybe we're a widow or widower, maybe we pause on that and see, does that get extended and have a bigger cap gain threshold for that? So just a couple thoughts, and we'll be watching out for how the tax reform happens this year.
Right.
So far, we've looked historically, we've looked at markets, we've looked at interest rates, and we've tried to take a comparison of where we are versus where we've been, and trying to dig into more to try to understand where we may be going. Let's take a minute to look at a different item, and let's talk about the U.S. debt. Obviously, the elephant in the room, we've got a lot of questions about the U.S. debt. We focus a lot on consumer debt. We focus a lot on the consumers, and obviously we're a consumption-based economy. It's what leads the markets. It's what leads the economy. But we're at a point now where maybe the U.S. has a spending problem. And so let's talk a little bit about that. Why don't you talk to us about the background of that and maybe where we came from to get to where we are today.
Sure. Yeah. So the national debt, what Andy's talking about here, huge elephant in the room, the $36 trillion elephant in the room. So when you look at the chart and you go back and see where has the debt been and where is it now, you can look back and see that it was relatively low. You have a little bit of a jump around World War II. Then debt's pretty well steady around under the $5 trillion range until you get into the 80s. And then you can kind of correspond the increases in the debt to things that are happening domestically. So you've got the war on drugs, you got an increase in the debt. You've got the 2000 financial crisis. You've got the wars in Iraq and Afghanistan. More recently, you've got the COVID stimulus money coming in. And you can really just see that debt start to ramp up. And it's really, if you look back over the last 2 presidential administrations, we went from, in 2016, depending on the numbers you're looking at, under $20 trillion in debt to now in the neighborhood of $36 trillion as a national debt. And that has just gone exponentially through the roof.
And it's really not a political party issue. It's really all of them.
It's a government.
It's a government. Yeah. It is.
Both sides.
And, a lot of people would argue, well, the U.S. is the leading economy. It continues to be the leading economy because of these stimulus programs, because of the debts that's been created. And I wouldn't necessarily disagree with that. The challenge, though, is at some point, we got to deal with it.
You got to look at it, yeah.
And, when we think about it, in my whole career, people have asked about the government debt. And the early part of my career, it was, we can get our way out of this. We can figure this out. We can inflate our way out.
That's right.
We can stimulate our way out. We can grow our way out. But the challenge now that a lot of people are confronting is it's getting to be a big number and a big percentage relative to other things. And it's not just an economic issue. It also is a number. If we don't get this under wrap, it's something that could affect us in multiple different ways. It's not just economically. It's, we own treasuries for our clients in their investment portfolios. When you put money in the bank has to turn around and buy treasuries to secure their lending. When you get insurance on your home or automobile, well, those insurance companies are going to own treasuries to secure their risk. So we're really touched by it in multiple different ways. It's not just the U.S. GDP or economic growth, which is massively important, but it's not just those areas.
Right. Yeah. So it touches every aspect of life, and really, whether you think about it or not, the U.S. debt is in there somewhere. Relevant.
And I think a lot of people think, well, it's China, it's Japan, it's the UK, they own so much of our treasuries. And they do, but really 80% of the debt is owned by domestic organizations or people. And of that, 2/3 is really owned within the U.S.
Yeah.
It's owned by somewhere that we're touching. So
which is like what you were saying, the insurance companies, the banks, the more domestically than internationally, for sure.
That's right. So let's talk real quick about the debt ceiling, the deficit. The debt ceiling, we have an interesting chart on that. It's rose so many different times. Does it really even matter?
And again, to your point earlier, politically, under both political parties, Republican control, Democrat control, anytime we hit that debt ceiling, we tend to just go ahead and raise it again and again and again.
Right. So, having to change some way around that, I think, is really important. And obviously the deficit. So you mentioned earlier, we had all these things. We had the Iraq-Afghanistan war. We had 2008. We had tax cuts under President Trump's first term. We had COVID, and those were big ticket items. But also, it's year by year by year. We have not had a surplus since 2000. That's almost 25 years.
Yeah, every year since 2001, we've been running a deficit. So we're spending more than we are collecting in revenue. Going back to a quarter century, add that up, and you're looking at $36 trillion of national debt.
That's right. So obviously it's a complex problem. There's lots of moving parts. It's tied together by a lot of loose parts. It's very complex, but how do we get out of it? What are some ways we could get out of this?
Two quick obvious ways. How do you get out of it? You cut spending, you increase taxes. There's obviously, if we cut spending, that could be an easy answer, but then you got to look at the short-term pain that we're going to create. If we cut spending, that's going to be an immediate corresponding cut in government jobs. So now all of a sudden, are we increasing the unemployment number? Yeah, potentially we are. We're putting a lot of people out of work. But is that better for long-term growth? Have we taken a lot of people out of the public sector and now given them reason to work in the private sector? Does that bode well for economic growth in the future, which is another way that we can kind of increase our revenue generated by the government to help us get out of this debt?
Yeah, and obviously there's printing money, so the U.S. government will never default on their debt. Never say never, but it'd be nearly impossible. We'll just print money and get out of that, which will have multiple issues in itself and, hyperinflation and whatnot. And then in the most perfect scenario, you have some type of economic boom associated with that. It's probably a bit of all of these.
I think you're right.
Argentina is going through this right now, obviously a very different economic situation than the U.S., but they're hitting it head on. They have a new president who said, hey, we're going to deal with this. We're going to privatize groups that were previously within the public sector. We're going to cut spending significantly.
Yep.
And we're going to tackle inflation. And inflation's come down significantly for, I think it's 30%, 36% annualized in October, which is still a high inflation number, but it was 211% last year. So trying to deal with that while also trying not to completely wreck the economy.
Right.
That's the perfect scenario. Argentina's one of the first to try to do this. We'll see what happens.
Yeah, that'll be a really interesting one to watch and to see. And then with our new Department of Government Efficiency, it'll be a good analog. They're a few years ahead of us on that endeavor, and it'll be something interesting to watch going forward, but definitely something to keep an eye on is the national debt and how we deal with it.
And I do think, talking about debt has been a political nightmare. And, I do have to say kudos to President-elect Trump for trying to tackle this. Not everybody's going to love the outcome. If whatever happens with it, not everybody's going to love the people at the helm. But it's a problem, and we have to deal with it. And it's something that is the pace at which the debt is rising is going up at just quite frankly an unsustainable path. So we got to do something. And so takeaways from this are a handful. One, just because the debt is where it is, it doesn't mean that this is a collision that's coming next month or next year. We could continue the pace that we're going down for a year, for multiple years. Gosh, I don't know, potentially a decade. So this isn't like a storm that's upon us. But when you look out on the horizon, it's definitely stormy clouds. So it's something we're going to have to deal with. I think there are some positive and negative outcomes. Positively, the U.S. continues to be the safe haven. We are the least corrupt, most efficient, most innovative country and economy. So if, we printed more money and our currency was devalued, we could become a big exporter. Our exports could be more valuable and less expensive. So there's opportunities there. Fiscal stimulus, however we want to quantify that, whatever were to happen, that can be good for the economy. We talked about the economic boom being.
Hopefully that would result that way. Yeah.
That's right.
Boom.
That's right. It could definitely be the outcome that we want. Or negatively, it could be a crisis of confidence within the U.S. We have been the leader out of the COVID situation. We're a leader, 9/11, the financial crisis. Obviously, 9/11 was more domestic, but globally affected global markets. We were the leader out of those. And so could there be the question of, well, yes, they were the leader, but they just borrowed money to do it. Just like in your own family situation, you don't want to borrow money to get out of problems. So it could be a problem with confidence. We could obviously see higher borrowing costs, which could see inflation, hyperinflation, which could affect GDP. And then obviously the biggest concern would be just some type of global contagion.
Right.
We are The U.S. touches a lot.
Because we're the leader, that's kind of the big worry is however we end up tackling this, we got to be careful about it and hope that we go about it the right way so that we're not the first domino to fall in a greater global issue.
That's right. That's right. So takeaway, big picture, this is a complex situation. It's something that's drawing more and more attention, rightfully so. Politically speaking, neither side is really strongly out there. You know, President-elect Trump is the first one to really try to put together a task force to try to figure this out. Easier said than done, but it's something we're going to have to deal with within the next, short to mid period of time. And it's something that we're going to be paying close attention to. Thanks, Frank.
Thanks, Sandy.
Hi, everyone. John Borbin here, joined by Brian Merton, our Chief Investment Officer. And we are going to attempt to tackle a tough topic of conversation these days, which are tariffs. Since President Trump was reelected or elected into his second term, I should say, tariffs have been a popular topic for debate. And so what we wanted to do in a quick video is just have a conversation a little bit about the history of tariffs in this country, some of the speculated tariffs that we may be facing, and then long-term, short-term, what are some of the impacts associated with that? So why don't you just kind of give everybody an overview of, how we view tariffs as far as the history of tariffs, I should say, in this country.
Yeah, sure. Thanks, John. So brief history on tariffs. We don't have a ton of recent history, obviously, but just going back in history, the Civil War really marked the beginning of a long period of U.S. tariffs. Our government had to figure out a way how to pay for what ended up being a very expensive war. And up until 1914, when federal income tax was introduced, tariffs were the main source of revenue for the U.S. government. So they help twofold. They help raise revenue for the government, and they also provide, theoretically protection for U.S. laborers and businesses. So really, these tariffs continued up until about 1934, when the Trade Agreements Act came into effect. That really set the stage for today's U.S. trade policy. So that's pretty much brief history. We saw a few tariffs implemented during Trump's first administration that actually carried over into the current administration. We obviously don't know yet the long-term implications of those policies at this point. Most economists tend to agree that up until this point, the policy's been slightly negative overall for economic growth, but that's still yet to play out.
Yeah, and I think the motivation behind the tariffs is really important. So we sit at a time in this country where we have two significant deficits. We have a massive trade deficit.
Right.
We buy a lot more from others than we export. And in addition, we have a budget deficit. So there is a thought that this could help cure or lead towards a solving of both of those issues. One, by generating revenue that would help cover some of our budget deficit, and then also, bring our trade imbalance a little bit back more. It's significant and appears to be growing. But with that, and to your point about GDP, let's talk a little bit about how a tariff in the short run might actually impact a consumer or a business, that might be exporting.
Yeah, so that's the biggest question of all, is who this cost passes through to the most. I think it's a split cost typically between the exporter, the importing company, and then what gets passed through to the consumer. We don't know at this point how much of that's going to get passed through to the consumer. So it's very difficult to forecast how it will affect overall economic growth at this point. I do think we'll see some pressure, upward pressure on inflation through these tariffs. Some of the projected numbers that I've heard, if we do get the 60% around there, which being proposed on campaign trail for China, some economists are projecting 30 to 40 basis points of increase in inflation. And if we get the the rest of the world border tariffs 10%, and they're forecasting upwards of 100 basis points of inflationary pressure from those tariffs.
And I think it will show this chart. One thing that we need to be conscious of too is, if we start imposing tariffs on imported goods or others exporting to us, retaliatory tariffs. There's a history of this, and you can see, particularly with China, there is a history where when we've imposed a tariff, they've simultaneously done the same thing to offset that. So it is going to have to be done very strategically, I think, to be done right. And there clearly are some short-term risks to economic growth. And the reality is that the most recent tariffs was the most recent impact that we've seen was in the Trump administration, because really, first term, I should say, we had not seen tariffs really utilized in this country for a long time. And what we're talking about is a much more broad impact from here.
Yep, that's right. And the goal of these tariffs is a sound goal. It's really to bolster U.S. manufacturing and bring jobs back to the U.S. So it is it makes sense from that standpoint. It's just how it plays out.
Yeah, it is the juice worth the squeeze. That's right. I mean, we really won't know. And if you're talking about reestablishing American manufacturing, it can take decades.
That's right.
Yeah. So it's not a problem that, implementing a tariff is going to solve the problem in the next weeks, right? Yeah.
One topic we wanted to talk about today is a common topic we're seeing in financial news media, nightly news, artificial intelligence, otherwise known as AI.
Right.
A lot of questions out there about long-term implications. Clearly, we've seen activities in the financial markets that have been impacted by the idea of AI and where it may take our economy. So let's just kind of start at a base level on what is AI and how we should think about it.
Right. Yeah. AI, artificial intelligence. It's rare you have a topic, John, where you have a 70-year-old client and a 17-year-old kid both interested in the same thing. But that's how pervasive it has become. And, I put it right up there with crypto, of things that are discussed the most but maybe understood the least. And so we can I put a chart up here, but there's a long history of artificial intelligence and machines starting to exhibit human behavior. And we're just a lot further on that kind of logarithmic curve of how much like humans machines can be. So a couple examples here. I'll start with Amazon. Mega cap tech company, huge in the conversation for AI, but they've been working on this concept, for 15 years. And so my wife is pregnant right now, okay? And I'm getting suggestions, would you like to buy a car seat? And why do they know that? Is there a human at Amazon that has marked her as pregnant? No. But there's things we're doing in our behavior. I don't know if it's prenatal vitamins or what, but somehow they know someone did this, and so this needs to happen.
Yeah.
And that is machine learning. It doesn't have to be able to regurgitate the thought process, but it has created a positive outcome for Amazon, because we bought a car seat yesterday.
Yeah.
We don't have a baby come for 2 months.
Yeah,
and we
working.
didn't go buy it at the local big box shop, right?
Yeah.
So that's expansion on Amazon's balance sheet, and that's been happening, and it's getting better and better as these companies invest. So now we kind of move to the next level from that deep learning, machine learning, to the topic that's been big the last couple of years, generative AI. So now the AI is like a human generating new content that it's synthesized from other sources where you've trained a model to do something. So this is what you're hearing about. If anyone has a child or knows a teacher, the kids aren't doing their homework anymore, right?
Yeah.
So college essays, Chat GPT, I'm told, can pretty much pass the bar exam in some cases, right? Because you can give a prompt and the AI model can put out a thought, that rivals maybe a high school or college level.
Yeah.
So that's
it's an interesting topic because, it's polar opinions on this, right? You mentioned the college paper or exam or whatever, college paper being created by AI. I've heard there are actually sort of counter technologies being created by universities to make sure that they can screen these things because it has become such a problem. But I think just in general, you see people super optimistic about what it can become
Right.
and just sort of the productivity gains that may be unlocked. But there's also a lot of fears around this idea. Do we really want to have our computers not only becoming smarter and smarter over time, but eventually being able to get as close to as possible to human intelligence,
Right.
which is scary. And I think that's sort of a sci-fi outcome if you
Right.
think about that idea. But I think in the near future, it's probably not as scary.
Right.
And I think when we think about where AI is today, what we pay attention to as investors really is where the money's going.
Right.
And it's clear when you look at the numbers, not only is a lot of money going into AI, the bulk of the money that's going in is from some of the top tech companies
Right.
in the world.
Right.
And they're not monetizing that yet.
Sure.
They're not making a return on that investment yet.
Not with new income.
Not with new income.
Yeah.
Correct. Good point. But they are spending significantly, and we've all seen NVIDIA do quite well just because they're the picks and the shovels of the gold rush, right? They're the ones providing the equipment to allow these language models to operate. So clearly, some of the smartest people in technology believe that we have a serious wave of innovation coming.
Yeah, and it has continued that each of those mega cap competitors, when you look at Facebook, Meta, Alphabet, Google, Microsoft, Amazon, they think it's really important to build out now. Not so much we'll wait and see if we can develop chips. That's why you see an NVIDIA exploding, because they all think it's valuable to do the build out now. Now that's a trend that could reverse.
It is. I mean, it's an arms race, and we've seen this in the past. I mean, clearly, you don't want to be left behind. If you're a cash-rich top 5 tech company, you're not investing in AI, you're making a pretty big bet against all of your competitors. And everyone wants to be a platform technology, where eventually you spend if on your phone or monitor or eventually goggles, whatever it may be, you're spending the bulk on that very platform. And so I think the next couple of years will be interesting to see if that trend continues. I mean, NVIDIA reported recently and still growing, but slow, showed a little bit of it wasn't a decrease, but it's call it a deceleration of growth. And so I think people are starting to read into, what do the next couple of years imply? So what are we seeing in the markets right now that, and how do we think about AI when it comes to making investment decisions?
Right. Yeah, I think a lot of it is AI has generated so much attention. And if we look over the past couple years, there's been an incredible outperformance on the side of these large cap tech companies. Some of the people who are implementing, like we mentioned, Facebook, Microsoft, Amazon, Microsoft, NVIDIA being the hardware side. But if we start looking at valuations, we're not buying a year of next year's earnings. We are way stretched to, almost levels of, historic, Amazon and Tesla right before they kind of made leaps in revenue of being way above the market. And if you look at some of the style ratios that we look at, growth versus value, and the P's on those historically, we're talking about, at times this year, over the last few months, historic separation between the two. So, I'd call that price to perfection, right? We have to really grow into those valuations by not only continuing on that straight line, but, continuing that logarithmic growth. And that's why you talk about NVIDIA. You can have an earnings beat in Q3 and have a down 10% day. Because it's, what have you done for me lately? How much are you beating the beat by?
I always like to say sometimes the narrative outperforms the reality. And that is always what innovative companies are going to be judged on. Expectations occasionally. The biggest example would be the tech bubble back in the late 90s, year 2000, where expectations just the narrative far exceeded the reality of what those companies would be. I don't think we're looking at a situation like that, but it wouldn't surprise us at all if some of these tech names, if they don't start to see some sort of ROI, return on investment from these dollars, that you might see them come under a little bit of pressure over the next.
That's the $1 million question. That's why I highlighted that together, they all have to reinforce the concept that this build out has to happen now, because we're not seeing new monetization like we're saying. Sure, Facebook's ads maybe can get served at a higher dollar per ad because the AI targets it better and makes you shop more, but we're not seeing, a whole new company and budget line being created.
That's
the
right.
question is, how long do they decide that this trend is the most important place for us to put dollars today?
That's right. Well, let's end this on an optimistic note. And I think AI has a long run, and it would be difficult for anybody to predict, what it really will mean for society in the next 10 years. But let's just talk about the next few years. I mean, productivity in the world could explode if these technologies are implementable and usable by, I would say, the non-computer programmer population, right? These are things that everybody in any job can use as a tool: virtual assistant, research assistant, something that can optimize the hours they have in a day. And we have a chart we're going to show here, that just shows some estimations on some of these productivity gains. I mean, it's really remarkable. Now, there's some challenges that come from that.
Sure.
Information workers, there's a lot of concern. If you're paid to know a lot of information, it's going to be hard to compete in this new AI world.
Right.
Yeah.
Well, you could say, I would almost say, what if it's the opposite? What if the information worker who is best equipped to utilize these new tools becomes, what you call a 10X worker?
Yeah.
Where now, since I know how to harness this new tool, I can go do what 100 programmers used to do.
Yeah.
Brian in our office has awesome software that trades. If you think about, the brokerage days 20 years ago, how big is the department that does his job?
Oh, exactly.
So this is a long trend of productivity.
Yeah.
I think we'll look back 5 years from now, though, and say, wow, this was one of the biggest periods of company formation.
Yeah.
Because someone who can utilize and is really efficient, you can almost have one person do something that 20 people used to do. So that's really optimistic.
Yeah.
As long as you're of the mindset of, let's get creative and not, my job's at risk.
Yeah. Well, I think we can both agree AI is here to stay. Definitely as a topic of conversation for the next few years.
Thank you all for listening to our video so far. We hope you've enjoyed it. We do these things really to try to give you all an understanding of the way we think about the markets, the way we think about everything going on in the economy. There's so many different aspects that play into where we position money, how we position money for people, whether it's the financial planning aspect, whether it's the economic aspect, whether it's the markets, whether it's inflation. There's just so many aspects to what we do. So we just wanted to give everybody a better understanding of the way we think and all the different things that go into what we're trying to do for each person individually.
Yeah, I mean, we're not day traders, right? I mean, we're in this for the long haul with clients. And so when we're talking about these trends, it's really important that our clients understand, these are the discussions that often lead to investment changes within their portfolio. And we're not looking or trying to guess where the market's going to be in a month or even 6 months, but we are recognizing economic trends that historically have actually impacted how certain asset classes have behaved. I think the big theme that I think everyone should just leave with is we're never going to have an environment where there are no issues in the air. Post-election, I think we're all glad that the election's behind us. I think it's better for the country to kind of have a clean result and let's move on regardless of the party that you're affiliated with. And so it feels like there's a little bit more optimism in the air. But I think that's even more reason to actually have a really good sort of data-driven perspective on how markets sit from a valuation standpoint.
Yeah, and we have a philosophy that has worked. It's not the most exciting, it's not the most sexy, but it works. And there's always going to be something popping up. If you just look back over 25 years, there have been several scary moments. We navigate it and we move forward, and we're not jumping in and out of things. It's, we're always looking ahead. We're always trying to position for people for whatever may happen, whatever may occur. So
yeah, I mean, crises are part of being an investor. That's right. And really in the last 5 years we've had, I wouldn't call inflation a crisis, but it clearly is an issue we hadn't faced in a long time. It's been hugely impactful to people's cash flow, spending budgets, and then COVID obviously was something that we'd never faced, and people still have lingering sort of PTSD from the financial crisis. and everyone's sort of looking ahead, what's the next thing, and usually everyone's paying attention to what they think is going to happen, and it's something over here that causes the problem. And that's why, from an investment standpoint, we never want to be wholly isolated on one potential economic outcome. Any number of different, 2025, 26, 27, we can all make predictions on what they'll look like, but there are so many outside variables that are virtually impossible to predict.
Yeah, and it's usually the thing you don't see coming, because we have lots of smart people in the world, lots of smart people in our country. We can navigate through the things that we know are coming. We know we have issues with debt. We know we have inflation, and it's still somewhat present. Whether we get a rebound inflation, we know those things are coming. It's usually that thing out of left field, and if we're not doing a good enough job on our planning side, I think that's where people can really have true harm. And so we always just want to be thinking forward. We always just want to be controlling the things we can control. Things are going to happen. There's going to be another market sell-off at some point. We know that's happening. We just got to make good decisions. So thank you all for listening in. If you made it this far, we're really glad you've listened to all these topics. We think a lot about it. We're always having these conversations behind the scenes. So thank you. We appreciate your trust. Always feel free to go to our website, ballastplan.com, or give us a call if you have any questions, 859-226-0625.